everybody. Let's go through a little bit of an educational background piece on what are health factors within Foliko. So first, a definition: our health factors or health scores, I'm going to refer to it interchangeably in this recording, are 6 different ways that we evaluate each company on our coverage list every day. So every company gets a renewed score every day, and that score ranges between -1 and 1. Let me show you. I'll pull up Foliko here and give an example of exactly what it is I'm talking about. So here on the screen, we've got today's dashboard for Foliko. I'm going to pull up a stock. One that we've been talking about a lot this week is Micron. So Micron, we have our health factors here. And you can see that today's scores are, moderately negative for their health factors. Competition -0.3, -0.29, 4.3, 4.5, 1.8, and 1.8 again. Let's talk about exactly what these are. So first, I'll take it right from the top. Competition. And let me swap things over so I can talk to everyone directly. Our competition health factor evaluates how a company is performing relative to all the companies in its space, but also relative to substitutions for its products. So one example we like to talk about is Nike. What if there's a barefoot movement really catching ground and everyone is just walking around without shoes now? Well, that would hurt Nike sales, which means that their competition score would angle downward, right? The next one that we have is earnings power. So earnings power is our way to reflect how a company is doing in terms of the way it's making money, directly from in the form of profit or revenue, earnings per share, everything like that. That's going to be loaded right into that factor. Next is management. How is the leadership team performing, and how is the contract between that leadership team and customers, as well as between the leadership team and employees? So if there's a whole bunch of talk about unionizing or things like this means that there's something not quite working between employees and employers, and that means the management score would angle downward. Reputation. This is the score where we can catch negative shocks for how people perceive the brand or values of a company. So for example, in the Gulf of Mexico and the BP oil spill, that would have caused a hugely negative spike to reputation for a company. Now, these 4 factors you'll notice are actually can be quite correlated a lot of the times. Suppose in the example of the BP oil spill, that would really cause a negative shock to reputation. It would be very expensive to clean up, and everyone would be doubting the capabilities of the management team. You might even have some swapping in and out of who is in that management team. This would cause competition to come in, and perhaps other companies could sweep in and take advantage of this gap that they're seeing in the reputation or capabilities of that company. And all of this is going to come together to lower the earnings ability of this company, which causes a dip in the earnings power health score. Now, what's interesting in these, just as a quick side note, is what happens or what it means when these 4 scores diverge. For example, suppose you have something where a company says they're going to raise prices. Well, this might lead to a really good era for earnings power, but at the same time, a decrease in the way their customers view their brand or their management team, which means that their management and reputation might really dip down. It's those divergences that we see some really interesting things happening in the market, and that leads to some deeper analysis where you can go in and actually dive deeper in the tool, find out what's going on. We saw some huge divergences in Twitter when Elon Musk made a bid to purchase them. A lot of people thought that Twitter's capabilities to earn more revenue under the leadership of Elon Musk would be really strong, but at the same time, Twitter's reputation and management were perceived very negatively at that time. And it said a lot about the future of the stock price of that company. So real quick though, I want to give a view from someone that has been actively working with these health scores for the past several months. So I'm going to bring in Tyler Tucci, who's going to give us a perspective on actually using these things. Tyler, how's it been going so far with these health factors?
I mean, it's certainly very interesting. When yourself and Nathan came to me with this project, I was, of course, very intrigued because of your data science non-market background, but also, of course, skeptical, just like anybody who, runs across someone who, claims to have a model that's market beating. So fast forward, some significant amount of time, and I've spent a good bit of time with the data, and I do see certain health factors that I think are tradable. In the case of the earnings factor, we've seen multiple times the earnings factor either start to run higher or lower ahead of the stock price right running into earnings, and we've been able to execute trades both bullish and bearish to take advantage of that. We had the big drop in Netflix, Costco, Target, and then on the upside, we were able to capture some upside in earnings beats in some beaten down Chinese equities, Kingsoft, KC being the one that comes to mind. So I do certainly believe that there is predictability in this. As I said, the earnings score is my favorite in terms of generating shorter term trade ideas. But I don't think that that's the optimal way to use Foliko. You of course can log in and see our favorite rank by upside ideas, and you can point and shoot at those. But I don't actually think that that's the best way to get everything out of Foliko. Instead, I prefer to pull out everything it has. I go across sectors, across indices, and confirm that it's telling the same story. I think that's important. I think, if you're bearish, semiconductors and bullish growth, I'd want to see why. But, we're very bearish semiconductors at the moment. We're very bearish growth. It all kind of lines up and is suggestive of a broader negative macro picture, which I think is, an interesting way to use this as well.
Absolutely. So real quick, I want to go in and actually take a look at where these health scores are coming from. Let's go from the ground up. So let's say, for example, I'm reading a news article on the fly, and 5 weekend stock stories. And there's a company that I've been looking at a lot, Micron Technology. This article is basically coming in and saying that, why does Micron deserve anything good on the valuation side? They're basically a commodity. They make chips. Yeah, sure, they do a good job at it, but those chips are pretty interchangeable from anyone else making the same exact chips. So there's nothing really particular or special about what it is they're making. This is obviously a negative thing. And if I was just a standard trader, I would take note of that in my mind and be like, oh, that's interesting. Okay, maybe Micron 1 point against. But I wouldn't know, what does the whole market think about this? What about the full breadth of what's going on in Micron's business? It doesn't really give me much of a view. What I really wish I could do, and this was a lot of the thrust behind why we made Foliko, what if I could compare what everyone is saying about Micron across all news outlets? And not only that, but I could benchmark that against what they said yesterday and the day before and 2 months before. Suppose 3 months ago, people were all saying, oh man, Micron, they're really coming out with some innovative, fantastic stuff. They're special. They deserve a higher PE ratio. And then now it's negative. That benchmarking against itself could be really interesting, but just as a standard trader reading news articles, I have no ability to do that. And that's where Foliko comes in. So I come over here to the health factors tab, and I get a view for what these long-term health factors are. But if I come in specifically to earnings power and I want to take a look specifically at negative earnings power, I'm going to see that same The Fly article that I was just looking at now. And you can see here, obviously that's coming down to a negative earnings power contribution score, minus 1.47. Okay. So we're able to take each of these articles and come out with a weighted estimation of what is exactly is going on in terms of how this company is being perceived or talked about by people. The next step that we do from a statistical standpoint is we take these earnings scores and we do a whole bunch of magic to them in order to get all of the articles speaking the same language. And so this means The Fly. How reputable is The Fly? How often does The Fly make predictions about a company that actually bear fruit, that actually happen, right? And then we look at every other news outlet talking about the same thing. Oftentimes, I get a lot of questions when we talk about our platform ingesting news. And that question comes down to very often, well, how do you account for bias in news? Or how do you account for just fake news? And the answer is, I love the saying, nature never draws in straight lines. And it's the same thing with news. If there's a bias about a news article, then that tells me something about their interests, and it tells me something about their motivation, and I can benchmark that against that motivation over a long period of time. And so all of a sudden, if Fox News, for example, is really negative about a topic, and then tomorrow they're negative about the topic, but slightly less negative, that's a positive indicator to me. And that actually would cause their health score to go up. Someone that's very typically negative, now positive, this is going to cause that score to appreciate. Now, not only that, but we actually have our health scores rated along 3 different levels. So there's things that people say about the company, but we also include things that people say about the sector. So even if a company doesn't have very much news going on about it, I can also benchmark everything that's being said in the same sector of the company, and I can tell you whether or not that sector is going down or up relative to these health scores, which is why you might see some rapid movements for a company, even though breaking or late news on them. The third level is what is being said about the market overall, because each of these companies are competing for capital amongst dollars that are invested in the market generally, right? So we have that 3-tiered view: what's happening in the market, what's happening in sectors, and what's happening in the company itself. That is also folded over a benchmark for the past 2 years. So one example is Amazon. Amazon, typically everyone loves Amazon. And this has been true for as long as we've been monitoring these numbers, since 2015. So let's go to Amazon real quick. So Amazon's health factors reputation is absolutely in the tank right now. Reputation is bottoming out. Is in particular much more than a lot of their other health factors. Now, that is probably due to some really negative news. You're not going to get down that low without some serious negative news spikes. But it is really hurt by the fact that typically Amazon's reputation scores are actually really high. For the past 2 years, it having a really positive reputation and it being low right now means that they've got to do a lot in order to repair their reputation value back to where it typically has been. So a couple negative news articles and just not as much positive is really going to hurt Amazon. Whereas if you compare it to a company that typically has a lot of negative news and now all of a sudden they're just not getting as much negative news, that's actually going to lead to it being a positive reputation score.
So one of the questions that I've gotten most often from our beta testers is, great, you have an article, you score it, you get a bunch of articles. So we have a bunch of articles on the same company, now we have scores. How do you take those scores and turn it into a line that oscillates between +1 and -1?
Okay, yeah. So this is all about normalizing these scores across a consistent standard. And this is really important so that we can compare health scores across each other. I have something meaningful to say that reputation is lower than earnings power, even though, say, a whole bunch more news is coming in about one instead of the other. So I've normalized these health scores against each other themselves. And this is a lot of Z-scoring type of methodology where we've been able to come out with how many standard deviations is this outside of that benchmark. That's really what this is representing. The other thing that's important to us is that you're able to compare one company against itself. So I want to be able to compare Amazon, which everyone and their cat talks about Amazon in the news, with Kingsoft, which no one in the news is talking much about Kingsoft, right? So does the health factor for Amazon actually come into something that I can directly compare with Kingsoft? And the answer is yes. And that's why we've normalized around -1 to 1, is so that you can have those direct comparisons. And it's really a representation of how far outside the normal is this. 0 would be it's business as usual. Everything's just fine. -0.2 would be things are a little bit worse than usual, but not so far outside of the standard benchmark to write home about. If you're at like a -0.8 or a +0.8, something huge is happening here. And that's why we've normalized to that scale. Does that answer the question, Tyler?
I think so.
Great. All right. I want to talk through, now that we've given a baseline for what these health scores are, I want to talk through what we've seen on historical averages and get you a little bit of your commentary on it, Tyler. So I'm going to pull up some code that I've written here. All right, so here we have just a quick set of code that I've written up to be able to evaluate how these health scores have operated over time. I want to give a little bit of a background into what this is going to look like. We're looking at a specific health score. So here we're going to take a look at competition, for example. we have a few different periods that we can look at this from. Short term is going to be up to 1 month. So in other words, a company has a health score today. What does that mean on average for its stock price over the coming 1 month period? The other thing that we can change here is the time horizon. So I have the 1 day, which means that I'm just taking the score for today. But what's interesting oftentimes is to look at how the slope looks. So if we go back to our picture for Amazon here, this slope on a 1 week basis, so if we take today's score and then we go back 1 week and we just imagine a straight line between the 1 week ago point and today's point, you would see that their competition score has a slight upward slope. Their reputation score has a slight downward slope. We can also do this on the 10-week basis. So if we go from today's score to 10 weeks ago, and you would really be doing it on 1 day here, but today's score to the score as it was 10 weeks ago, you can get a sense for what that long-term slope has been for the health score of a company, right? So if for this one, it would be, and this is just me estimating live here, your ESG score has depreciated significantly. Your competition has gone down a little bit, but that's a really gentle slope downward. It's really your reputation score that has a sharp downward slope, okay? So that's the way that we're evaluating companies in this view. We're going to start with just that 1 day raw score and what that looks like. And we're going to plot out what this looks like. Now, give me a second just to explain what's happening here. I have put all of these health scores into bins that go and increment by 0.1. So remember, it's a scale of -1 to 1. That means there would be 20 bins of size 0.1. So this blue bar all the way to the edge is the average stock return for all the companies that had a between -1 and -0.9 health score today. And you can see their average stock price change in 1 day. Now, here's the other thing I want to talk about. This part is the 1 day stock price change. This is the 3 day stock price change, 1 week, 2 week, 3 week, 1 month, or 4 weeks. Okay. So that means that if we come to the competition current health score, I'm really not seeing much of a relationship. And I want to check in. Tyler, what I'm saying, is this making sense?
Yeah.
Okay. All right. Keep me honest here. And if you have any questions about what we're seeing, or you want to go a little bit deeper, be the voice of the audience for everyone here. Keep me honest. Make sure I'm not just talking too deep data and things like that, right? As well, when we're showing this, submit your questions, and we'd love to get to them. We are going to be holding AMAs all the time, so you can come in. If you have any confusions about these scores, how they're calculated, what they mean, we're going to be there. On YouTube is the best way during our live shows to ask questions. I know we're broadcasting on 4 different channels, but YouTube is the best way for us to answer it live. But this competition score, 1 day later, I'm really not seeing anything to write home about. That's not significant for me to start believing in it to trade on. We go 3 days out. Highly negative is actually positive, and then highly positive is seeing a little bit better. But even out to the 1 week, I'm not really seeing as strong of a relationship as I would want to do. From if you pair out -0.7 to -1, sure, you see something interesting there of this straight line that goes up from -0.6 to +1. Yeah, you start seeing a relationship popping out. For competition scores, though, it's really the 2 to 4 week that we start seeing one hell of a relationship. Like, look at this. You can't make that stuff up. I mean, that is a very strong relationship. Someone with a good competition score versus a bad competition score, this is something that makes a difference. And you can see that here at the top, a 1 competition score is leading to, on average, across all of our coverage list, across all of the dates that we cover, that's 1.8 million data points. Okay. On average, this has led to an appreciation of stock value over the course of 2 weeks of a little over 1%. So what is that? 1.2%. Come to the 1 month, and that relationship just continues piling up in strength. Now, something interesting here, -0.9 to -1 is less indicative than -0.8 to -0.9. That's actually something that I have noticed happening over and over and over again. I don't like trading the 0.9 to the ones on either side, because I see a lot of volatility happening in those buckets across all 6 health scores. Well, maybe not ESG. We'll talk about that in a second. ESG, I wouldn't trade on. That's about giving you the nice feels while you're trading. But coming in here to the 4-week, let's go to another one here. Actually, let's keep looking at competition and talk midterm. That relationship keeps going strong up to 6 months. So here we have 2 months, 3 months, 6 months. That relationship still keeping strong. Once we hit 9 months, today's competition score is really looking a lot less relevant. Statistically, I would say we don't have a strong relationship there. Certainly not something strong enough to trade on. So for competition scores, you're looking from 2 weeks to 6 months. That's that strength pattern that we're really looking at there. And again, the benefit it's giving you is weaker and weaker as you transition from 2 months over to 6 months. Okay. All right. I've been teasing ESG for too long. Let's look at ESG. Across pretty much all time horizons, especially when you bifurcate this by industry. Now you can go extremely deep with these scores. So I want to do a close up here to talk about this, because I think this is important. What competition means while the market is up, while it's a bull market versus a bear market, means something different. What competition means in the tech sector versus the basic materials sector means something different. That's why we have subscriber-only events within Foliko to give these very deep details of how exactly you should be thinking about each individual sector. Tyler, we've been going deep lately with just some sub-sampling in sectors, right?
Yes, we've been going through, sector ETFs. We've been doing, emerging markets. Tomorrow we'll probably take a look at some utilities, if I could give a teaser. But we like to look at these lists and we like to compare strength, and we can, given, the output of Foliko, have a very good view of, strength versus weakness by running the output of these models against one another.
Yep. And once you start doing the joint variable analysis of what happens when you have a high competition score and a low earnings score? On average, these relationships just keep piling up stronger and stronger, and it leads to some really interesting strategies coming out of this. All right, let's get back to it. Then you have something like earnings power. Earnings power is interesting. Again, we're looking at that 14 to 28 day window as being really particularly powerful here, right? Again, really, really negative, like the minus 0.9 to the minus 1. High volatility in that bucket. But one thing that you were pointing out, Tyler, that I really like is that when your earnings power is that low, does that start to become a marker of a bottom?
And right? we kind of think, it certainly has sometimes pointing back to we believe the 0.8 to 0.9 is optimal, whereas 0.9 to 1 starts to be suboptimal. And I kind of think we're picking this up there as, once you're scraping against the bottom, the pressure needed to maintain, and by pressure, I mean the negative factor contributions needed to maintain a downward trajectory just becomes, in some cases insurmountable. So you do get some recycling off the bottom, not because things are getting better, just because they're not getting any worse.
Yep. And look at this data. I mean, this data supports that story so well. When your earnings power is there at the very bottom, over the course of one day, you're going to go down on average, right? It means you're just about to see a little bit of a turnaround is how I look at this data, because look at the 0.8 to the minus 1, 3 days later, 1 week later, 2 weeks later, we're seeing really that as a marker of this having been an opportunity. So earnings power, that's one of my favorite scores. We can come into reputation. I think that's also another interesting one. Reputation has a strong correlation. We're not waiting for the 2 week on this. We see that correlation really popping all the way across. Not as high of values typically from your earnings power. But when you start seeing these variables, especially moving in tandem and going together, that is a fantastic thing. I want to bring us over back to earnings power and look at slopes now. This was something I didn't expect. I love this. I love building out data sets and then having the data sets inform me and challenge my worldview. That's the best case situation, is because you know that you're not imputing your own biases into it because you've just been disproven. And this was something that did that to me pretty strongly. So this is, again, the 10-week slope. Okay, how are these earnings scores changing, or health scores changing over 10 weeks, and this specifically the earnings power one. So on the 1 day, 3 day, 1 week, pretty standard, pretty given. Once we get out to a month, we start to see this relationship getting stronger and stronger, where you don't want to be on too steep of a slope going either up or down. Now, I think that's fascinating. Let's get out to the midterm. And look, this relationship just getting more and more clear. You don't want to be on too steep of a slope either direction. Tyler, how would you explain that? Why would that be?
From the non-data science standpoint, I guess it's just signaling volatility. It's signaling change. So, the reaction to earnings is, not just purely a function of did they beat whatever, the street consensus is. It was, how's everybody positioned? What are the other things that are going to be impactful going forward? Is this a highly indebted company that we want to find out whether or not it's a going concern, or is this, is it a tech high flyer where we want to find out what they think is going to happen next quarter? And I guess, if I had to have form a hypothesis, basically that movement and that lack of stability, is bad for price. But, I prefer, your theories on this way better than mine.
No, it's so, and it's always great to get the trader perspective and the data science perspective. I love it because look at this 3 and 6 month. What you're really looking for is that gentle upward slope. That's where the highest returns are, that gentle upward slope. So if I could do anything with a company that I'm invested in, I would want it to have positive earnings power with a gentle upward slope. And that means that we've reached a nice stability that's getting even better over time. That's something that I would be ready to jump in on. Let's look at the 1 week. 1 week tells us that same story. That 1 week slope at the 3 and 6 month range, again, gentle upward slope. That's where that power is coming in. That actually extends over to the 9 month as well. And look, we're running out of time for today, but we have a lot more of these to go into. Like I said before, doing it sector by sector, doing it by a subsection of a sector, like going in for utilities or something like that, doing it by market conditions, bear versus bull, or even using all of these health factors together to come together and form an overall market consensus. This is something we're looking at constantly, like in our current bear cycle. Are we reaching a market bottom here soon? Our data has some interesting things to say about that, especially when you look at it sector by sector. But join us every morning, Foliko Live, Monday through Thursday, 8:30 a.m. We're going to give you more content like this, and we're going to go even deeper.